What I'm going to say will anger many financial advisors. For the past 20 years, the retirement industry has been peddling you a fairy tale called RMD, a required minimum allocation that will detonate your retirement life like a tax bomb. They labeled it ticking time bombs, traps, waiting 73 mines, and used it to sell you Roth conversions, annuities, life insurance plans, and four-figure financial plans you might not need. After talking to hundreds of retirees and looking at what the actual numbers say, not what the industry says, I'll give you an honest answer. For about 90% of Americans currently watching, RMD doesn't matter. No, they're a little more important than you think. No, they're manageable. Mathematically, they're really not important to most people. And over the next 22 minutes, I'll use IRS forms, Pioneer data released in December, and Morningstar's own retirement research to explain in detail why. At the end of the video, your retirement plan will look completely different. If you're new, subscribe and let's get started. Chapter 1. What is RMD and why do the rules exist? Let's set the level first, because half the panic around RMD comes from people who don't fully understand what RMD is. A minimum requirement is that once you reach a certain age, the IRS forces you to withdraw funds from your deferred income tax retirement account. We're talking about traditional IRA, SEP IRA, Simple IRA, 401s, 403s, and 457 plans. Basically any account where you can get a tax break as long as you enter it. Why bother the IRS? It is simple. The government allows you to compound interest to delay taxes for 40 years. They are patient with you, but they will never let you die without collecting. The existence of RMD eventually led to tax cuts by the Treasury Department. The first thing the YouTube guru didn't adequately emphasize was that RMD didn't apply to every retirement account. Roth Ella is tax-free. As of the 1st of January, 2024, Roth 401s was also exempted under the Safety 2.0 Act, and health savings accounts never required them. If you've been donating to Roth through your employer's program, congratulations, the money has been decoupled. The current age of RMD is 73, a change under the Safety 2.0 Act signed on the 29th of December, 2022. Before that, he was 72, compared with 70 and a half in previous decades. Starting on the 1st of January, 2033, the age of people born in 1960 and later rose again to 75 years. If you are 55 now, 20 years before the IRS asks for $1, just sitting in front of that fact changes the emotional weight of the conversation. Chapter 2. Numbers that reveal the whole myth. This is the moment when the whole RMD panic collapses. To calculate your RMD, the IRS uses a method called the Unified Life Table, which divides your account balance as of the 31st of December by a number in the table called your distribution period. To get your RMD for the year, here are the actual numbers, taken directly from the current IRS form. 73. Your placement period is 26.5 years, and the calculated withdrawal rate is about 3.77%. By age 75, the menstrual cycle dropped to 24.6, or about 4.07%. At 80, it is 20.2, or about 4.95%. And once you are 85, it drops to 16.0, or 6.25%. Now, no one on financial Twitter wants to admit it. Morningstar, China's most respected independent retirement research firm, released its 2025 Retirement Income Research Report, which concluded that the maximum safe initial withdrawal rate for a balanced retirement portfolio was 3.9%. Look at that number. 3.9%. By the time you are 73, your first year SRMD is 3.77%, meaning that the IRS, with its boundless bureaucratic creativity, has unexpectedly devised an exit schedule that is almost exactly what independent researchers call math safe. Everyone's fear of a tax bomb is that money will be pulled out at roughly the same rate. and financial planners tell you to pull it out anyway. Christine Benz, head of personal finance at Morningstar, has a good point, and I quote her directly here. The glib answer, she wrote, is that this is a required minimum allocation, not a required minimum expenditure. You have to withdraw money from a traditional deferred tax account to pay taxes due at age 73. But you don't have to spend money. Let's wait. The IRS forces you to distribute the money, but they never force you to spend it, which means you take it out, pay taxes, and then do whatever you want with it. Cash can go directly into a taxable brokerage account, where you continue to invest. You can give money to your children, donate it to charity, buy a boat, and the cash flow belongs to you. The core of the RMD problem is the timing of taxation, not wealth. Chapter 3. This table is for your benefit. Few people talk about the next point, and you'll be a little shocked. The Unified Life Table is deliberately generous. Here are the numbers drawn directly from the Social Security Bureau's actuarial table. According to the United States Bureau of Statistics, the average life expectancy for 73-year-old American men is about 12 years, while the average life expectancy for women is about 14 years. Now look at the IRS form, and 73-year-olds are assigned to be 27. The IRS is basically planning your withdrawal plan as if you are going to live to 100, because the Unified Life Table assumes that for everyone, regardless of marital status, you have a beneficial spouse 10 years younger than you. Even if you are single, even if you're a widower, even if your spouse is your age. This is the Treasury Department's considered design choice, adding a buffer to the formula so retirees do not accidentally run out of accounts while one or both spouses are alive, resulting in a much more conservative RMD percentage than the single life expectancy table gives. As early as 2022, the IRS updated the table again to reflect longer life expectancy, which made the RMD slightly smaller. Imagine a 75-year-old with a $1 million portfolio. Under the old form, retirees would be forced to withdraw $43,668. Under the current table, that figure drops to $40,650, meaning a decrease of $3,000 a year, simply because the IRS creates an additional cushion. When financial advisors warn that RMD will force you to use up your account, they are either misinformation or selling it to you. Mathematically, the probability that the RMD method will never run out of your account is 100%, which is not my view, but directly from Morningstar's research, because this formula calculates the percentage of the remaining balance, which means you really can't run out of your account this way. Chapter 4. Why is the punishment that people fear not the same as before? It is time to talk about punishment, because fear is real. For decades, missing an RMD meant the IRS levied a 50% sales tax on the amount you didn't withdraw. Half gone. It is listed as the most severe punishment in the whole tax law, which really confirms the myth that RMD is a mine. Here is what has changed and what few people talk about. Under the Safety 2.0 Act, which took effect on the 1st of January, 2023, the fine of 50% was halved to 25%. That number would be better if errors were found. Realizing that you missed it and corrected it within 2 years means that you actually took the step of distributing and submitting IRS Form 5329, and the fine dropped again to 10%. The worst case scenario for missing out on RMD has gone from the IRS takes half your money to the IRS charges 10% for things you forget to withdraw. And you can apply for an exemption if you have a reasonable reason. This is not a mine. It was a parking ticket. Here is what happens in real life. Pioneer released a paper in December 2025 titled, "What is the cost of missing RMD?" Your report, what? They checked every IRA on the platform. And of all these accounts, 6.7% of investors missed RMD completely in 2024, missing an average of $11,600. Even at the 25% rate, the average penalty would be around $2,900, down from around $1,160 at the revised 10% rate. That is the number we're worried about. And for the average offender, about $1,100 in a six-figure portfolio. But this is the most interesting part of the pioneer story. Of those who missed RMD, 56.8% had an account balance of less than $5,000. Only 2.5% of investors with more than $1 million left out. The people who are really hit by the RMD penalty are those who have small accounts that are not important for retirement, and the wealthy and sophisticated retirees targeted by the YouTube tax planning video almost never miss the RMD because they have consultants. They have automatic assignments, and the system has worked for them. Chapter 5. Why do most retirees still have to pay? Another data point completely suppressed the RMD panic balloon. Research published by EBRI, a nonprofit organization that has studied retirement behavior in the United States for 40 years, shows that the vast majority of retirees use RMD as the default exit strategy. They don't resist, they don't shy away, they use it as an income plan. Pioneer S 2025 data directly support this. In 2024, 69% of customers withdrew at or above the RMD level. Another 24% withdrew below the RMD level, and only 6.7% of small silver bars missed the withdrawal completely. Think about what that means. About 7 in 10 retirees withdraw at least RMD because they need money to make ends meet. They have mortgages, medical bills, grandchildren, travel, property taxes, Medicare premiums, real life. The IRS did not force them to do anything they did not intend to do. The RMD trap exists only as a meaningful tax issue in certain scenarios. A retiree with a very large tax deferred balance, a large amount of external income from pensions, rental real estate, or Social Security, and he really does not need RMD cash to fund his lifestyle. If this is your case, we'll take care of it right away. However, for the median number of retirees in the United States, according to Fidelity, its analysis of 18.9 million accounts at the end of the fourth quarter of 2025, the average IRA balance of the account is $137,100, and the RMD of the account at age 73 is about $5,170 a year, less than $500 a month. This is not a tax bomb. Costco. Chapter 6. The gap year for the industry to make money. But to be fair, not all of this is nonsense because there is a real industry built around RMD planning. And some of it actually provides real value to the right people. The strategy you often hear about is Roth switching, and the idea behind it is simple. Between you retire and age 73, you get what is known as a gap year. When your income falls to or near zero, you haven't received RMD, and you may not even have started Social Security, which means your taxable income may have been artificially low for years. During this window, you can withdraw money from the traditional IRA, tax it at a lower level, and then transfer to the Roth IRA, which is always tax-free and has no RMD. For a wealthy retiree with a $2 million, 401 pension, this strategy is sure to save six-figure lifetime taxes, and I won't pretend not to. But that is where the industry exaggerates. They adopted this strategy, really helping about 10 to 15% of retirees and selling it as a panacea, scaring a 62-year-old teacher who had $300,000 in 403 and made her think she needed an active Roth transition or her retirement would collapse. Unlikely. For people in this situation, making Roth conversions after retirement usually increases their lifetime tax bill because their current tax rate is in the range of 22% or 24%, which would later reach 12% or 22% under their actual RMD plan. Math doesn't apply to everyone. it applies to some. And the YouTube ecosystem doesn't always tell you who you happen to be. Before you write a $4,000 check to a fee-only planner to optimize your RMD, ask yourself an honest question. What would my actual tax bracket look like when I was 75? If you can't answer that question, the transition strategy is not ready for you. And the plan is ready. Chapter 7. Tools you actually have. Let's import the legal tools the tax code provides for a small group of people who really need to manage RMD. Tool 1 is a qualified charitable distribution, or QCD. Once you reach 70 and a half, you can transfer money directly from your EIA to a qualified charity, which is included in your RMD but does not include taxable income. It is listed as the most powerful charitable giving tool in the United States tax code and is almost unused. Under Safety 2.0, annual QCD limits are now linked to inflation. The ceiling is $105,000 in 2024 and $108,000 in 2025. And you need to confirm that year's figure with the IRS, which is now adjusted annually. If you're going to donate money to charity, it is no-brainer. Send money directly from your IRA. You skip income, you skip taxes, you complete RMD, and you don't even need to itemize to get charitable benefits. Tool 2 is the exception that is still running. Few know that if you are still working at age 73 and you own no more than 5% of the company, your current employer, S401 plan, may allow you to postpone the RMD in a particular plan until the 1st of April, a year after retirement. This exception does not apply to former employers, IRA, or 401s. But for current ones, you can continue to postpone. If you are 74 and still working part-time, talk to your human resources department and ask if your plan allows it, because many people do. The third is voluntary early withdrawal. You can get fine-free withdrawals from the IRA at age 59 and a half. And if you worry that the impact of RMD in the future will push you to a higher level, one of the cleanest ways is to start withdrawing at a lower level at your own pace in your 60s. Every dollar you pull in advance is a dollar and is no longer in your RMD base. Tool 4 covers aggregation rules. The IRS complicates matters. For multiple traditional IRAs, you can calculate the RMD for each IRA separately, but you can extract the total amount from any IRA to give you total flexibility. But this part is critical. 401s and 403s do not allow aggregation. That is, each plan must have its own RMD, which is separate from the plan and mixed together will cause compliance confusion. If you are dealing with multiple old 401 plans from past employers, here is a suggestion that most consultants agree. Merging them into an IRA before you reach RMD age simplifies your life, reduces missed tasks, and gives you the flexibility to aggregate. Chapter 8. Things to worry about. Well, I spent 15 minutes telling you why RMD doesn't matter to most people. So let me be honest with you about what matters. The real concern is not the RMD itself, but what happens when the RMD is superimposed on your other retirement income. Imagine a typical middle-class, retired couple. Both are receiving Social Security, like $60,000 a year, plus a small pension worth $20,000 for one person. They also have a traditional IRA of $1.2 million, with an RMD of about $45,000 at age 73. That means they have $125,000 in taxable income before spending $1 in brokerage savings. Suddenly, 85% of Social Security becomes taxable. They slip into the 22% federal range, and they may exceed the IRMA threshold and pay higher Medicare Part B and Part D premiums over the next 2 years, plus 4 to 9% if they live in income tax states. That is the real RMD problem. This is not distribution per se, but an interactive effect. with Social Security taxes, IRMABA brackets, and capital gains squeezed as ordinary income rises. However, this is only important for retirees with significant deferred tax balances and significant other taxable income. The problem is not widespread, and the solution is not panic. The solution is a tax forecasting spreadsheet that honestly examines your expected income at age 73 and a strategy that spans years. If you have fewer than 500,000 households in a traditional individual retirement account and you are enjoying normal Social Security, you will almost certainly live in the 12% range. IRMA threshold won't touch you. Your Social Security tax is full, and RMD won't actually change your tax life. Chapter 9. Why the industry cries out. So why has the financial media been shouting RMDs? There are 3 reasons. First, fear works. A calm, mathematically driven explanation. You may be fine, doesn't generate traffic. But headlines like, "The IRS is about to explode your 73-year-old retirement," are sure to generate traffic. And the economics of YouTube and financial media have alarmed everyone. Second, it is a sales funnel. RMD anxiety is the entry point for selling Roth conversion services, index annuities, life insurance, and high-cost managed accounts. Because if you're not afraid of RMD, you'll become a harder customer and give the industry all the incentives you're afraid of. Third, and one reason to be more compassionate, is that planning is really important for a small group of high net worth retirees who do have RMD problems. And many consultants have built careers for that group. In their world, the problem is real, and the mistake is to assume that everyone lives in that world. In fact, as Vanguard's data show, the people wrongly destroyed by RMD are those who have $5,000 IA, but forget to accept distribution. Not those who have a 7-digit portfolio and face a tax grade cliff. Chapter 10. What should you really do? This is a clean framework. And if you are 45 to 65 now, that is what I'm really focused on, not obsessed with the future of RMD. The first step is to diversify your tax bucket while you're still working. If everything you own is in a traditional 401 account, start sharing your contributions, some in Roth, some in a taxable broker. If you have a high deductible health plan, and some in an HSA account, because in the future, you will thank you for your choice now. The second step is to simulate your actual income at age 73 on a spreadsheet. Consider your current account balance and predict a reasonable growth rate, say 6%, to see if your RMD is actually 73, plus Social Security, pensions, and rental income. If your projected total income is 73, putting you comfortably in the 12% or 22% range, you don't have an RMD problem, you don't need to do anything, and you can stop worrying. Third, if your forecast shows taxable income of more than $250,000 at age 73, yes, start thinking about the partial Roth transition in your 60s, a few years after you stop working, but before Social Security and RMD take effect. Because this is the gap window, which is where math really pays off. The fourth step is to consolidate accounts before age 73. Consolidate old 401 accounts into a single IRA and set up an automatic RMD with the trustee. Because that is what wealthy retirees in Pioneer data do, and few of them miss the task. Step 5. If you are a philanthropist, plan to start using QCD at 70 and a half. QCD is listed as the most efficient charitable tool in the US. Tax code, and most retirees don't even know it exists. That is the whole framework, 5 steps. And note that none of them involve panicking in a 25% fine or paying someone $4,000 to save you from RMD. Because for most viewers, nothing can save you. RMD is built into the tax code as a backstop, a mechanism for the government to eventually collect the taxes you've been delaying, which have never been designed to be punitive. The penalty dropped from 50% to 10%, The starting age was postponed twice. The Roth account is now tax-free. The withdrawal ratio is in line with what independent researchers call the safe withdrawal rate. And there are so many buffers to build a unified life table that it is assumed that you will live to 100. It took the retirement industry 20 years to turn a relatively simple administrative rule into a horror story of selling products. If you're sitting at home with a normal portfolio, hundreds of thousands of people in your IRA, Social Security on the way, maybe a paid-off house, the real story looks like this. RMD is inactive. You'll take the money, you'll pay taxes, life will go on. And this rule, designed to protect the IRS from fraud, will work exactly as it is prepared for you. Don't let anyone intimidate you into strategies you don't actually need. If this video changes your view of retirement, do me a favor and delete one comment. From 1 to 10, depending on your age and your concerns about RMDs, because I've read them all. If you want to watch the next video, I'll analyze it in detail when Roth's conversion is meaningful and completely wasteful. Click subscribe, ring the bell, and see you in the next video. Take care of yourself, plan wisely, and stop fearing the wrong things.